We're analyzing Linde, stock ticker LIN, to see if it's a great business on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Linde. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Linde for your stock portfolio. Before we get into these valuable metrics, let's understand Linde's stock performance. Right now, Linde trades for $364.51 per share. Year to date, Linde beats the market. Their stock price is up 14.5%. In the last 5 years, Linde's compounding at 17.5% annually. In the last 10 years, they're compounding at 12% annually. Going back prior to the global financial crisis, in the last 18.5 years, Linde's stock is compounding at 12% annually. The company's stock price is up nearly 9 times. Right now, Linde also pays a 1.34% dividend yield. Their average dividend yield throughout this time is in addition to these returns in their stock price. Linde trades just $20 below their 52-week high. They trade $100 above their 52-week lows. Just under 1% of their shares are sold short. Linde is a huge business. They have a $178 billion market cap. But the burning question is, why should we be paying close attention to Linde? Linde is the largest industrial gas supplier in the world, with operations in over 100 countries. The firm's main products are atmospheric gases, including oxygen, nitrogen, and argon, and process gases, including hydrogen, carbon dioxide, and helium, as well as equipment used in industrial gas production. Linde serves a wide variety of end markets, including chemicals, manufacturing, healthcare, and steelmaking. Linde's also owned by several super investors. It's in the AKO Capital portfolio. Wally Weitz, the lesser-known Omaha value investor and Berkshire Hathaway director, has about 2% of his value fund in Linde, and Thomas Gaynor, co-CEO of Markel, has about 0.5% of his portfolio in Linde. Keep in mind, this is just what shows up on their 13F filings. This doesn't include their international holdings. Now that we have this understanding, let's get into the numbers. Starting off with metric number 1, we want Linde's average return on capital in the last 5 years to be above 14%. The average business earns about 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based off the quality of the business. Linde's returns on capital have increased in all 5 of these years. Their returns were down in 2018 due to their merger with Praxair. Praxair was the largest industrial gases company in the Americas. At the time of the merger, it was the 3rd largest worldwide. The two companies merged after October of 2018 for an all-stock deal valued at $75 billion. Due to this, Linde's return on capital are going to be lower in these years, but we see these have been increasing. But in their last fiscal year, they earned 10% returns on capital. When we average these out, Linde earns about 6.2% average returns on capital in a given year. That's slightly below average and down from the benchmark we're looking for. This is an X on metric number 1 for Linde. Metric number 2, we're looking for growth to go along with their increasing returns on capital. We want to see revenue, net income, and free cash flow growth in the last 5 years. This metric's all or nothing. All 3 need to be up to be a check. We'll also include their numbers up until today as we calculate their growth. In this time, Linde's revenues have more than doubled due to the Praxair acquisition and some organic growth. Their earnings until today are up just 2%. The highlight for Linde is that their free cash flows have almost tripled. Free cash flow is the lifeblood of any business. Ultimately, a business's abilities to produce cash flow until Judgment Day, discounted back by some reasonable interest rate, is what that business will be worth. We'll be using that exact method later in our video, so stay tuned. With all 3 of these up, this is a check on metric number 2 for Linde. Metric number 2, we're looking at Linde from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. We learned that Linde's earnings or their net incomes have grown by 2% over this time. So we want to look at the company's shares outstanding to see if they've grown this on a per share basis. Because of their all-stock Praxair merger, Linde has diluted shareholders by 50%. That's a huge amount. It really depends if Linde was issuing these shares below or above its intrinsic value. And you need to understand the quality of the company that they got back to understand if this creates or destroys value for shareholders. Because of their dilution for that merger, this is an X on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. A different story from their earnings per share. Linde's free cash flows per share have tripled over this time. That's outpacing their 50% shareholder dilution. This is a check on metric number 4. To recap where we stand currently, through 4 metrics, we're split evenly. We have 2 checks and 2 X's for Linde. During recessions, overly levered businesses can have the biggest losses. Metric number 5, we want Linde's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 years. Right now, Linde has over $13 billion in net debt. In this time, their free cash flows have tripled, largely due to the company merging with Praxair. When we add up their last 5 fiscal years of free cash flow, Linde's generated just under $21 billion worth of free cash flow that easily supports their net debt position. This is a check on metric number 5. Linde seems to use a modest amount of debt in their business and they generate a lot of cash flow. We'll calculate a fair value for Linde, but first, it's time for our bonus. As our bonus, we're looking at Linde's dividend profile. Linde is a dividend aristocrat. They've grown their dividends in each of the last 30 years. Right now, they pay a 1.34% dividend yield. We want Linde to support their dividends using their cash flows. That's been the case in all 5 of these years. Linde has grown both their dividends per share and their free cash flows per share. They've also decreased their dividend payout ratio as their free cash flows have grown faster than their dividends. And as we just learned, it looks like they're using reasonable amounts of debt in their business. While this is a snapshot of their last 5 years of performance, it's no guarantee for the future. Linde seems to comfortably support its dividend. This is a check on our bonus. The big metric of them all, metric number 6, we want Linde's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Linde. Right now, Linde has a $193.5 billion enterprise value. This looks at Linde similar to it being a private company. It accounts for both their market cap and their net debt position. In the last 5 years, we learned Linde produced just under $21 billion of free cash flow, meaning in an average year, Linde produces about $4.1 billion of free cash flow. When that's divided by their enterprise value, we get about a 2.1% average free cash flow to enterprise value yield. On a current basis, Linde produced $5.4 billion of free cash flow in their last 12 months. When that's divided by their $193.5 billion enterprise value, it gives us about a 2.7% current free cash flow to enterprise value yield. Both of these are coming in below the yield of the 10-year treasury, meaning they're below that risk premium as well. Coming in on metric number 6, this is an X for Linde. Don't just throw the business out. We still need to estimate their fair value per share. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Linde, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of Linde's last 3 years worth of free cash flow, then growing these into the future using historical assumptions. It's up to you to figure out if these are going to be accurate or not for Linde going forward. Assuming they grow these 3-year free cash flows at a rate of 7% annually for the next 10 years. Then in the following decade, if this growth rate is cut in half and these grow at 3.5% annually, if we add in their tangible book value, this gives an estimate of their net worth. If we want a 15% rate of return, which is what Warren Buffett's looking for in his investments, from today's valuations, if these multiples stay the same in 20 years, an estimate of Linde's fair value per share is around $115. That's down a lot from their current stock price. There are some key points to keep in mind. Linde has not been that predictable of a business in its past. This is partly due to their big Praxair acquisition, which for $75 billion in stock can skew some of these assumptions. Also, this discount rate is an estimate of total returns to shareholders based on their free cash flows. It would already be including their dividend yield. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Linde, but we have to address something first. We've covered the numbers, but the qualitative factors of Linde's business may be even more important. What are they? Well, let's find out. Looking at the factors supporting a long thesis, number 1, strong demand for on-site projects in Asia could fuel strong revenue growth in the region. Number 2, Praxair has historically earned industry-leading margins thanks to its vertical integration strategy. If management can leverage the same to Linde's low-earning asset base, the company could significantly boost its profitability. Number 3, the Praxair-Linde merger positions Linde as the largest industrial gas company in the world, strengthening the company's competitive position. But we'd be remiss if we didn't cover the negatives as well. Looking at the factors supporting a short thesis, number 1, a reversal to sluggish industrial production growth in North America and Europe could lead to slower growth and earnings uncertainty. Number 2, strong competition from other industrial gas major and local companies for new contracts in emerging countries, especially China and India, could result in depressed returns in those markets. Number 3, cost inflation and energy price volatility could pressure short-term margins. There you have it for a balanced perspective of some of the qualitative factors for Linde. Now it's time to give our rating. In analyzing Linde, stock ticker LIN, we learned this dividend aristocrat has grown through their Praxair merger. They're earning slightly below average returns on capital, but those have been improving. Their revenues and free cash flows are up big, even though they've diluted shareholders by 50% for this merger. Linde seems to generate enough cash to support their net debt position. They support a growing dividend using a small dividend payout ratio. Again, this is not financial advice. Looking at their free cash flow to enterprise value yields, Linde does not look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, if Linde's multiples stay the same, you believe those assumptions and you want a 15% rate of return, an estimate of Linde's fair value per share is around $115. Linde last traded at those levels in June of 2016, so you need to be patient. Looking at all the factors of our analysis, Linde looks like a modest candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Linde, and let me know what business to look at next in the comments below. Thanks for learning about Linde with me, and have a great day.